Driven by a global energy shock and rising geopolitical tension, headline inflation has spiked back up to a severe 3.81%. At the same time, if you're keeping your savings in a traditional bank account, you are likely earning the national average yield of just 0.62%. When you plot that 0.62% yield against a 3.81% inflation rate, the math becomes incredibly unforgiving. That widening gap represents your money actively losing its value. You aren't just standing still, you are falling behind. This makes leaving capital in standard accounts as lazy cash a high-risk decision that guarantees a loss in purchasing power. To reverse this, we are going to evaluate 4 asset categories. We'll evaluate cash, physical hard commodities, strategic real estate, and targeted equities to find the exact right fit for your tax bracket and liquidity needs. Surviving 2026 requires moving away from generic passive saving and toward an active, targeted strategy. We start with the first branch, short-term cash for emergencies. A common move is a high-yield savings account, currently yielding up to 4.1. Optimizing cash isn't about finding the highest number on a screen. It's about balancing tax efficiency against your need for immediate access. Next, we move to hard assets, tangible goods that tend to hold their value when paper currency is losing its own. Gold remains the classic choice, especially now that central banks are aggressively diversifying their reserves away from the US dollar. This institutional demand has analysts forecasting gold could reach the $5,000 or $6,000 range within the next year or two. But we are also seeing massive potential in industrial metals like copper and silver. This chart highlights a structural supply deficit. The physical demand from green energy projects and AI data centers is simply outstripping the current supply of these metals. Some institutions are now applying this same logic to Bitcoin, treating its capped supply as a digital hedge against central bank money printing. Hard assets provide a strong shield against devaluation, but they require you to handle higher price swings and forego the regular dividends of stocks. For long-term wealth, real estate offers a unique double-layered defense. First, there is replacement cost. As inflation drives up the price of labor and raw materials like timber and steel, the value of existing buildings is naturally supported. Second, and more importantly, is the advantage of holding a fixed-rate mortgage. While the value of the dollar drops, your mortgage payment stays the same. You are essentially paying back your debt with cheaper dollars, while your property's value adjusts upward. This mechanism reverses the threat of inflation, turning a depreciating currency into a tool for building home equity. Finally, we have to look at your stock portfolio. The era of easy, broad market gains is facing a headwind. Persistent inflation is starting to compress corporate margins. Success in 2026 requires targeting companies with pricing power, blue-chip brands that can raise prices to meet their costs without losing their customer base. There is also a massive growth engine in the $800 billion infrastructure supercycle being driven by artificial intelligence. This involves targeting the physical side of the boom, the industrials, hardware manufacturers, and utility companies building and powering data centers. Because this growth is fueled by massive institutional capital expenditure rather than household shopping, it offers a pathway that is largely insulated from the consumer-driven inflation we see elsewhere. Growing your equity in 2026 requires moving beyond passive index funds to focus on the physical construction of these future technologies. To make this actionable, we've mapped these strategies into a matrix based on your specific life situation and risk tolerance. First, the cautious saver. Your goal is to preserve what you have without taking on unnecessary complexity. You should stay away from volatile commodities and focus on optimizing your cash through HYSAs or I-bonds to protect your immediate savings. Next, the tax burden professional in a high-tax state. For you, standard interest-bearing accounts can be a mathematical trap. Focus on state tax-free T-bills for your cash and use your fixed-rate mortgage as your primary long-term hedge against inflation. Finally, for the aggressive allocator, holding too much cash will actively drag down your total performance. you should lean into rotating your equities toward AI infrastructure and acquiring industrial metals that are facing supply shortages. Take a look at your current exposure. Identify which profile matches your reality and start the process of rotating your assets. There is no single solution for 2026. Beating inflation requires aligning your personal financial goals with the specific tools designed for this environment.